monetary, non-monetary. Fine. Okay. And then the sixth is coordination. Yes, by ensuring all these things, what happens is there is a smooth coordination between all the departments. Is that clear? Yes. And then while using the techniques of management accounting also, we take data from all the departments, so at that time also we ensure there is smooth coordination between all the departments. Fine. Okay, then the seventh is controlling. So controlling means what? Controlling means comparing the performance, actual performance, with the standard, right? So we are going to help to set the standards by way of standard costing, budgets, right? And then whatever deviation is there, we will suggest to the management whatever the corrective action that needs to be taken. Fine. And then the last point is, see, decision making. Yes, we help the management in making all the decision because we provide the relevant information about the things. Don't think that management doesn't know about things. No, they do know, but we provide deep analysis of things. That's the most important part. Okay, fine. Now let's just talk about limitations of management accounting. And what are the limitations of management accounting? First is dependent on accounting information. See, we all know we first gather the data. From where do we gather? From financial accounting, cost accounting, and many more are there. So we are dependent on this. So this is kind of a limitation for us. Okay. The second is wide scope. Yes, we have said there is such a big scope of management accounting. So if the management accountant is not competent enough, then he can make mistakes because so much he has to cover, isn't it? Too much information is also not good because he wouldn't be able to come to a correct conclusion. Is that clear? And then the third is emerging area. Yes, understand management accounting is not developed completely yet. There are no standards, nothing. Okay, it's still in the initial stages. Is that clear? So it's not fully developed yet. The fourth point is expensive. Yes, it is very expensive to install management accounting system in the organization because you have to pay high salaries to the financial analysts, to the management accountants and all. Okay. And then the fifth is personal bias. Understand there's a lot of judgment involved in management accounting. What happens over here? We do financial analysis and interpretation. So this interpretation thing, it can be, what do you say, according to personal judgment. Fine. So because of that, there can be personal prejudice and it may lead to personal bias. Now what happens if there's a personal bias? It can impact the decision badly. Okay. And then the sixth point, see here, resistance from the staff. Resistance from the staff means if we are installing the management accounting, then there will be change in the organization. We might have to change things. We have to set up new rules and everything. Yeah, already we have accounting staff. So then new staff is coming. So because of that, there can be resistance, which is natural. So that's also kind of a limitation of management accounting. Is it clear? Okay, now let's just discuss about a practical example of management accounting. Let me just show you. Let's just say, for example, there is a company called as RP Electronics, which is in need of a component, right? Let's just call that as component X. So now we have two options. Either we make that in-house in our company itself, or we buy it from outside. Okay, we have the ability, we can make it, or we can buy it from the outside supplier. So this is a decision that management has to take. And how the management will make the decision? We have to help them. We have to do this analysis. What is this analysis? Make or buy decision, we can say, or cost versus benefit analysis. See here, two options are there. Either we make it or buy it. First, we will calculate the cost, the total cost of manufacturing it. Yeah, and here we are just going to take the purchase cost. Whatever quantities that we are purchasing into the purchase price, that will be the cost, isn't it? Yes. And then you also have to look into the qualitative factors. It's not just the cost. We don't always look into the cost. Yeah, qualitative factors are also important. Understand, see here, if we make in-house, then what will happen? There will be greater control over quality. Yeah, there will be potential for innovation or improvement. And then see, understand, one con is there. The con is we will have to look over everything. Yeah, we are producing it, so we have to manage the production, logistic, and the workforce and everything. But if we buy from outside, the operations will be simple. We are not producing, we don't have to manage anything, we just have to purchase. It's a simple thing, right? But the thing is, we will be dependent upon the supplier's quality and his reliability, isn't it? Yes. And then the third is prices may change in future of that supplier, right? So we also have to look into the qualitative factors, not just the monetary data. That's what I said here, use of non-monetary information. Is it clear? Now one practical example that I can give of this is of Apple company. Yeah, what did Apple do in 2020? Apple used to purchase its chips from Intel, right? Then what did they do? Then they started designing their own chips, right? Apple Silicon M1, right? M1, M2, now M3 has come out, right? Yeah, so they have shifted to this. Yeah, they are making their own chips, isn't it? Yes. Okay, so this was the complete introduction to management accounting. If you have any doubts, please comment down below, or you can always message me on Instagram. So that's it for this video. See you in the next video.